All right, well, let's just get you some global perspective now. Robert Sockin is with us. He's global economist at Citi. Robert, great to have you with us here. Thank you very much for your time. So what has the Fed meet done for markets incrementally? Has it raised confidence that we will get that 25 basis point cut in September? And not just that, that this is perhaps going to be the beginning of a rate cutting cycle? Is there greater confidence after what we heard from Fed Chair last night?
Absolutely. And thanks so much for having me. I think what's always important with these Fed meetings is you get a lot of information about how the Fed is viewing the economy and how the Fed is viewing market pricing. And what we heard from Chair Powell, in my view, is that he and the rest of the committee are really setting the stage to cut in September. And I would be very surprised given his tone today and the improvement that we've seen so far on inflation, if they were not to cut rates once we get to that meeting. So I think that was one very important takeaway. I think another important takeaway is that Powell emphasized that they are focusing on both sides of their mandate. They've seen enough progress on the inflation front to feel that they're getting close to being able to ease policy, but they're also starting to get a little bit concerned about some of the softening they've seen in some of the indicators on the activity and labor market side. The economy has held up well, but the risks of a slowdown, I think, have risen as rates have been higher. So I think that's the other important takeaway, which putting both of those together, I think really does pave the way for the start of an easing cycle once you get to September. Now, it's going to depend on how resilient the economy is and how much inflation improves from here. But I think you're going to get one cut in September and then maybe one or two more cuts this year. And then next year is going to depend on how resilient the economy is and the inflation developments.
Okay. Robert, hi, good morning. So typically when the Fed cuts, everybody parties, right? Now, the party's been on for a while in anticipation of this September cut. So what's your sense? And the bond market is rejoicing. We saw the 10-year yield fall to about 4%. Stocks are anyway rallying. Even gold has been moving higher for other reasons as well. So what's the sense? If the cuts start coming in now, then are we looking at elevated asset price levels?
Yeah, I think for these other assets as well, it's going to depend on how resilient the economy is. So in some sense, it's going to depend on why the Fed is cutting rates. Right now, I think what you're seeing priced into markets and what the broader consensus is that we are getting some type of a soft landing scenario. Now, as I mentioned, there are some risks that the economy could slow down more, but broadly speaking, the economy has held up well and inflation has continued to improve. So I think that is a very positive environment for equities. And I think you're seeing that priced into markets. So if the Fed enters a cutting cycle and the economy is resilient, that's kind of the best of both worlds for risk. Now, if the Fed starts to cut and the economy slows down more and they have to cut because a recession is ensuing, that's a very different outcome. To me right now, the data are feeling more like a soft landing. Our house-based case is that you will get a sharper slowdown in activity. But I think most market participants, I think what you're seeing priced in the markets is more of that soft landing flavor, which would be very positive, as noted, for risk.
Hi, Robert. Morning, and thanks for joining in. Well, you've told us in the past that from the equity markets, India stands out, and that was the preference out there as well. I wanted your reading on what the Bank of Japan did. They've slowed their bond buying program, and also they went ahead and they cut rates. Implications of this, for the time being, the Nikkei is down close to around 3% odd. That was showing signs of coming back. I think it returned to those levels we saw, say, 30, 40 years ago. So, but view on that market as well as implications.
Yeah, absolutely. And, this was a difficult central bank to call because what you have seen in Japan is you've seen inflation pressures hold up or pick up relative, of course, to where they were pre-pandemic. So, there has been hope that Japan will be able to sustainably hit its inflation target. At the same time, the currency in Japan was feeling enormous pressure. And at times you saw very weak currency levels. And so the question became, was Japanese policy going to respond to the weakness in the currency, or were they going to keep rates relatively low for longer to kind of help ensure that they end up hitting that 2% inflation target? And I think what you ended up seeing was that the Bank of Japan was concerned about some of these currency pressures and felt, given how high the Fed has been throughout this year, that it was time to start raising rates as well. Now, if the Fed had cut rates earlier this year, that would have taken pressure off the Bank of Japan to raise rates, because I think the currency wouldn't be as weak as it has been. So I think you're seeing the Bank of Japan not only respond to what's been going on in its own economy, but what's been happening with Fed policy as well. And I think more rate hikes are coming from Japan, given what we've seen come out of that meeting. So very interesting dynamics, not just in the US, but what we're seeing with global monetary policy.
Robert, good talking to you. We live in interesting times. Let's see how this plays out. Thank you very much for joining in and for the perspective today.